let's talk about SoFi Technologies. SoFi is a fintech company that has been getting a lot of attention in the past week and has become one of the highest traded stocks in the world. But is SoFi really worth it? In this video, I will discuss the latest news and the impact that this will have on SoFi as a company, while I will also provide some analysis of the price action and what price I expect to see in the near future. I will look at both the bull case and bear case scenarios for SoFi so that you can get the best possible information on which to base your opinion. Too often YouTube videos only discuss one side of the story, and with the upcoming SoFi earnings due in the next few weeks, there is a lot to look at. If you enjoy my content and don't want to miss out, subscribe and turn on notifications so you will be alerted whenever I make a new video, and show your support for my work. Check out my new Patreon page where you can support my work and get access to when I find these new opportunities. If the Patreon group is not for you, that is fine too, of course, but if you find any value in this video, can I ask you to tap that like button and leave a comment? This costs you absolutely nothing but really helps the channel out. Now let's get into today's video. If you are new to SoFi Technologies, SoFi is an online personal finance company based in San Fran. They provide financial products such as student loans, mortgages, personal loans, credit card, investing, and banking through their mobile app. As it says on their website, SoFi's mission is to help people reach financial independence to realize their ambitions. SoFi went public in a SPAC merger with Chamath Palihapitiya's company IPOE in July 2021. The deal was announced back in January 2021 and was finalized in July, but SoFi was founded in 2011. In this time, SoFi has developed a comprehensive suite of products that offer the speed, selection, content, and convenience only an integrated digital platform can provide. SoFi is headed by CEO Anthony Noto. Anthony is a vastly experienced professional who previously joined Goldman Sachs in 1999, and by 2003 he had become a managing director, becoming a partner in 2004 before leaving to become Chief Financial Officer of the NFL. He later returned to Goldman, where he headed up global investment banking before joining Twitter in 2014. He held the role of Chief Operations Officer at Twitter before joining SoFi as the new CEO in 2018. As we can see here from the investors presentation, SoFi's revenues have been greatly increasing during this time, going from just 241 million in 2018 up to 912 million for the last 12 months, while also achieving positive EBITDA, and I will discuss this a bit more in just a moment. For years, this company has been used as an alternative to banking. They offer products that a bank offers without being an actual bank. This actually increases costs for the company in terms of how much it has to pay to acquire funding. That is, up until now. This week, SoFi obtained the charter to become a national bank after the fintech company's applications were accepted by the Fed and OCC. SoFi will form SoFi Bank National Association, pending its acquisition of Golden Pacific Bancorp next month. It says here that the acquisition of Golden Pacific Bancorp is anticipated to close in March. But according to another article that I've read, the deal was announced last year and it's expected to close in February. So what does this mean for SoFi? With the National Bank Charter, not only will we be able to lend at even more competitive interest rates and provide our members with high-yielding interest in checking and savings, it will also enhance our financial products and services to ensure they efficiently meet the needs of our members, business partners, and communities across the country, according to the CEO. Or in other words, by cutting out the middleman, SoFi gets a bigger slice of each transaction. CEO Anthony Noto said a national bank charter will allow lending at more competitive interest rates. Now, for the bullish case, SoFi is a game changer. So with fintech getting smashed in the market in the past few weeks, there is no doubt the space has been oversold, but is largely still very expensive. However, the valuation of SoFi stock, while stretched, is justified in that it is not only has massive fintech growth, but a pending catalyst in this charter. The charter means the company is going to pay far less to lend to customers. This combines with the already very low cost to acquire customers. The company was doing well margin-wise with its loan, and lending rates going higher are a big positive, at least on earnings per loan. SoFi now will be able to use their money market and other deposits to finance their own loans. Lending is SoFi's biggest source of revenue and profits. Right now, money is being borrowed, limiting the spread. This will dramatically reduce the cost of funds and immediately boost margins. We are talking about a possible $1 billion in profit margins in the next few years. So while SoFi continues to grow fast, in the most recent quarter, SoFi saw total members grow 96% year over year to 2.9 million, up from 1.5 million at the same point last year. And total products grew 105% to 3.3 million at quarter end, compared to 2.3 million at the same point last year. Now, a very interesting point is this. Being a bank allows the company to now offer various products and savings and checking accounts, which can help increase the deposit base from which to draw on, but also push customers into investing products or investing customers into saving and checking. Now, this has the effect of possibly dramatically increasing the customer base, but they could even offer high interest savings accounts to attract deposits to use in lending. Becoming a bank really does offer SoFi so many options on how best to grow its business, and in my opinion, having someone like Anthony Noto as CEO, they are very capable of having every chance to succeed. This article concludes with, at these levels, the stock is a good buy under $15. Yes, the stock is expensive on present growth, but the future of fintech and now the bank charter in hand, shares could move higher and shares have a solid risk-reward ratio from this level. Looking at TradingView, we can see that since the time it was announced that SoFi would go public through a merger with IPO SPAC, which was announced back in January 21, and since then the stock has continuously been moving in this range between $13 and $24. SoFi this week dropped to its lowest point since the merger was announced, but quickly bounced back on the bank charter news. And I feel that this might just be the start. As you can see here, I have highlighted in purple what looks to be a repeating pattern all year. I feel this might be starting to take off again now. So with a February date set for the deal to be completed, and judging by what has been going on all year, I would expect this to build up in the coming weeks. Going off today's price, I feel that there could be about 70% upside in the coming weeks. But don't just take my word for it. According to Morgan Stanley, SoFi's launch of a bank could help drive 43% upside. The investment bank said it sees a base case price target of $20 reflecting 43% upside, but for its bull case, Morgan Stanley strategists are calling for a $28 price target, over 100% upside from the stock's current level, which today is $13.89. Looking at market beat, we can see that SoFi is in the bottom quarter of both its 50-day and 52-week range, which implies that SoFi could now be extremely sold and offer huge upside. The average price target is $21.70, and a number of analysts have weighed in with price targets over the past 2 weeks, ranging from as low as $17 up to $30, with most rating SoFi as a buy or giving an equivalent rating. Now, for the bearish side of the story, some believe that SoFi is overvalued and the fair value is just $7, citing that both member and revenue growth have begun to slow, and a slower growth rate in the coming quarters must be anticipated. Now, I don't agree with the points that are made in this article, but I feel my viewers should be aware of this. What is problematic is that membership growth rates have skyrocketed, owing primarily to COVID-19, implying that growth rate may slow significantly once the pandemic is downgraded to an endemic. The rate of growth in membership additions had already slowed in Q3 2021, but it remained extremely high. Memberships increased 96% year over year, after increasing by more than 100% in the previous 2 quarters. Although this argument does have some merit, I don't agree with it. As the numbers increase, the percentage growth is always going to decrease. And the author even points to the fact that Q3 21 was the second highest growth rate for SoFi since inception, so there is no indication of any problem here. The second bearish point is with slowing membership growth comes slowing revenue growth. And many more quarters of slowing membership growth may follow as COVID becomes less of a concern in people's daily lives. So once again, the concern is slowing growth due to COVID. The author here cites the pre-pandemic SoFi only had a 54% growth rate, which is much lower than pandemic area growth rates. Again, although the growth rate here is a fact, I don't agree with this point. For one, COVID has had far less of an impact in 2021 than in 2020, where full-scale lockdowns were enforced, and yet the growth rate was far higher in 2021. It could be a case that more and more people have become aware of and trusting of SoFi. So let's look at the numbers. The growth rate from Q4 19 to Q1 2020 was from 976,000 members up to 1.086 million. That is an increase of 110,000 members or 11% quarter over quarter. While Q2 21 to Q3 21, there is an increase of 377,000 members, which is more than 3 times the growth rate, despite only being a 14% quarter over quarter growth rate. Never forget the power of compounding growth rates. Guys, if you appreciate this type of analysis, can I ask you to smash that like button? And check out my Patreon page, which is the first link down below. The final point here is the so-called fair value of $7 per share. Once again, this is based upon growth rate. SoFi revenues will grow at a rate less than half that of last year, around 45%, and pandemic-like growth rates are likely to be a thing of the past. SoFi Technologies' fair value would be around $7 at a 5.5 times sales multiple, implying a 50% downside. Again, I do not agree with this at all. It completely disregards any progress the company has made and the impact of the bank charter. This argument is basically saying that the pandemic is the only reason for SoFi's growth. I do not agree with this, but I wanted my viewers to be aware of both sides of the story and not just hear all the good points. If you appreciate this type of content, please smash the like button and help me grow this channel. That brings us to the end of the video. Drop a comment and let me know what you think of SoFi. And make sure to pop over and check out my Patreon page, where I'm bringing you the latest stock ideas that I believe will make huge gains this year. At the current price, I think this provides a great opportunity to get into SoFi stock. I think there is a lot of upside here, as I've shown you on the charts a few minutes ago. Let me know how much impact the end of the pandemic will have on SoFi in the comment section, and if you have invested and at what price. This is not financial advice. I am not a financial advisor, and my videos should be viewed for entertainment purposes. I highly recommend investing only money that you can afford to, and always do your own due diligence when investing. If you're new, subscribe, turn on notifications, and I'll catch you in the next one.